A2 specification with regard to financial markets. I was very fortunate to invite Miss Lucy Armstrong into school just a few weeks ago on the 17th of March, and Lucy is an expert in banking regulation, and so she was kind enough to give my sixth form students just a little rundown on the UK financial crisis. So I thought, what better to do than to share it with you subscribers. So that's what I'm going to do today, ladies and gentlemen. I hope that you can see this. At the end of this, I will zoom in on the document itself so that you can get a good look at it. If you'd like a copy of it, I could maybe upload it to Dropbox or something like that, where you can take a copy of it for yourselves. So, on the 17th of March, Lucy was very kind to just give us a sort of a 12-point rundown on the origins of the UK financial crisis. So she started off simply by pointing out that the UK financial system is, of course, one of our areas of comparative advantage, one of the areas which we're relatively good at and specialise in. And we are dealing with vast sums of money here, ladies and gentlemen, on a daily basis. So, for example, on a typical day, the FTSE puts through and trades around about £120 billion. That is per day. So we're dealing with enormous sums of money. Now, Lucy was keen to stress that, of course, politicians are not bankers. Indeed, many of them may be lifelong politicians. In other words, the only thing that they've ever known is to be a politician. Well, the fact that they were not, in this instance, bankers, that really was quite detrimental to the way our response to the financial crisis, and also what happened in the run-up to the financial crisis. Because politicians, for example, they didn't really know how banks operate, and so things such as, you will all understand, of course, how the credit multiplier works. Well, it might have been the case, and probably was the case, that many of the politicians who were involved in trying to retrieve the situation after the crisis, they were not aware of these things. Now, Lucy worked, I think, quite closely and alongside Mr. Peter Mandelson and Mr. Vince Cable, whom I'm sure you will have heard of both of those gentlemen. And it's a very tricky balancing act for the politicians at the time, because they had two messages to send out. There was on the one hand a business responsibility, and on the other hand there's a public responsibility. So what are these conflicting messages? Well, if we take the business responsibility first of all, the banks need to lend, and in order to get the economy, of course, out of a recession at the time, the deepest recession in post-war history, then on the one hand, Mr. Cable and Mr. Mandelson will have had to have been telling the banks, look, you need to be lending, because we want lending to take place, and we want investment in business to take place, because we need the economy to expand. So we need you to lend as banks and financial institutions. But on the other hand, there is a public responsibility. And that public responsibility is, well, actually, on the other hand, Mr. Cable and Mr. Mandelson, we're going to tell the financial institutions that they need to cut back on their lending, that they need to be more strict on their lending criteria, for example. They need to be hammered for being reckless. So we then went on to discuss at the time how the banks, for example, they were lending people many multiples of their salaries in order to buy a home. So the norm nowadays is maybe 2.5 times your annual salary. Well, back in the early noughties and in the run-up to the financial crisis, it was possible to borrow 4, 5, 6, even if you lived in central London, maybe 7 times your annual salary. Well, I mean, that is just, think about it, it's just madness. It's too good to be true, that, and it's madness. And giving people sort of, if the house price was 100,000, well, give them another 20,000 on top, because they could then use that £20,000 to deck the house out in the finest of wares and so on. So on the one hand, there's a real contradiction here. They've got to tell the banks, look, excuse me, be careful with the money that you lend. Don't give out recklessly. But on the other hand, telling the banks, actually, we want you to lend, we need you to lend, we need to get business stimulated, and we need to get the economy moving. Now, you'll all be familiar, I'm sure, with Prime Minister Margaret Thatcher in the 1980s, 79 through to the early 90s. And she was primarily responsible for the deregulation of the financial markets. So what do we mean by deregulation? We mean the removal of restrictions and regulations on the market, making it, it meant really that as a consequence of that, banks were unleashed from the shackles that they had previously been constrained by, and as a consequence they were able to make these, for example, these reckless types of loans. And of course, when things were going well, nobody batted an eyelid at this because things were all hunky-dory. And as a consequence of this deregulation, during the 1980s there was a vast increase in personal wealth, and bubbles began to build up, particularly, of course, in the housing market. As more and more money was being put into property, the property prices were just growing and growing and growing, and so this property bubble was getting bigger and bigger and bigger. Now that, of course, came back to bite us in the depths of the financial crisis. So where did this financial crisis begin? Well, it began in the United States. But because of the nature of the globalized world, the interdependence of one country upon another, the interrelatedness of financial markets between one country and another, because of that, when a problem starts in one part of the globe, it very quickly spreads to another. And you'll know that to be referred to in the jargon as systemic risk. And so this whole threat of contagion built up and has been building because of this globalized nature of, in this instance particularly, financial markets. So you will have heard, no doubt, of the subprime mortgage market in the United States. Now, what is the subprime mortgage market? Well, Lucy gave us this great illustration, which I shall share with you. So what was happening in the American mortgage market was this. Houses in Beverly Hills, which required mortgages, and in Miami, which required mortgages, and in Detroit, Michigan, which required mortgages, they were all issued with mortgages. However, the people in Beverly Hills and the people in Miami were much wealthier, and therefore much more able to pay back loans, and therefore less likely to default on a loan. In other words, to stop paying it and not be able to pay it back. However, what the financial institutions in America did is that they bundled all of these loans together. Beverly Hills tip-top, Miami tip-top, Detroit not so tip-top, and they bundled them all together and labelled that whole bundle as being, for example, a package of mortgages equivalent to people who were paying back from Beverly Hills. So it wasn't labelled accurately. Now that in the Northeast, for example, where we are, would be equivalent to, for example, loans being issued in Darras Hall, very exclusive area, in Jesmond, another nice exclusive area, and in Gateshead, which is still okay, but obviously the property prices would be a lot less, and perhaps people's ability to pay back would be that little bit worse as well. And bundling all of those together, and then just calling that and labelling that bundle Darras Hall. That gives you a false impression as to what you're actually buying. So it's a sort of a mis-selling there. There's a misinformation going on. Information failure, if you will. So that is a great example actually of asymmetric information. So the people who were bundling this thing together, they knew, but they didn't tell anybody else. And so you take on goodwill and on good trust that you're buying what it is labelled as, but unfortunately it wasn't. So what then happened with these bundles of mortgages, these bundles of money which were wrapped up in America? Well, they were sold all around the world, but we bought a lot of them here in the UK, hence the problem in the UK banking system as a consequence. And they were sold as if they were tip-top sort of AAA credit. And they were bought by banks, particularly in the UK and particularly in the northeast of England here, obviously, by the Northern Rock. And the Northern Rock used the cheap American money to fund its UK mortgage business. And at the time, if you pretty much anybody who was anybody looking for a mortgage in the northeast went to the Northern Rock, because the rates that they were offering were substantially lower than anywhere else. And why wouldn't you do that as a rational home buyer? However, the Northern Rock didn't really know what they were buying. Obviously didn't really question it, although perhaps this question should have been asked that this maybe looks a little bit too good to be true. But anyway, they borrowed it in good faith, let's say, and they were still able to make a profit on the difference between the price they were paying the American financial institutions to borrow the money and the charges that they were making to the UK customers as they issued those funds as mortgages. And so they were still making good money on that. And so that obviously illustrates to you how cheap that American money must actually have been. However, we must question this again. Surely somebody at the time should have said, this looks too good to be true, and maybe somebody could have consequently looked into that and investigated it. However, what will be, and obviously what has happened and come to pass. And because of this globalized nature, as we've talked about the interconnectedness of the globe, there was contagion. And as home buyers in America began to default on their loans, the American financial institutions then started to recall their money from UK banks. Now, the UK banks had to honour their commitments to the US financial institutions because they had made commitments to them and they were in contracts with them. And of course, an economy functions because of, and this was a great phrase that Lucy used, because of a flow of promises between people and between individuals. And when these flows of promises start to break down and people begin to doubt them, and when funds then suddenly start leaving banks, then you develop what we saw here in Newcastle, which was a bank run, where we had people queuing around the block in Newcastle city centre trying to get their money out in the hope and anticipation that they might be able to get their money back, because as the money was just disappearing out, as the UK banks honoured their commitments back to the US. Well, how was that problem stemmed? Because of course the Northern Bank almost, well, it did, didn't it? It went bust effectively. Well, the UK authorities stepped in. They didn't necessarily pump any money in, as so-called, but they offered what was referred as a sovereign guarantee. So the UK authorities said that they would cover the bank's assets. Now that is an enormous commitment. The RBS, for example, largest bank at the time, had £1.7 billion worth of assets on its balance sheet. Now when you think that the UK economy probably is just producing something in and around that at the moment, then that just shows you what a commitment that was, given that the UK economy's GDP per annum is about 1.7 billion, and they're honouring that and all other UK banking institutions. So this put the UK authorities, meant they were very highly leveraged with regard to the amount of debt that they were being asked to cover. And there's also the issue here of moral hazard. Is it right that the UK authorities should step in and offer to cover the bank's assets? Because in what way, you'd have to say, in what way would that encourage the banking sector to amend its behaviour? You'll be familiar, I'm sure, with the whole question of moral hazard. Contrast that with Iceland, where something similar happened, but its three largest banks were allowed to fail, and the government actively pursued reckless banks and bankers, Senior executives were jailed and the ex-Prime Minister was put on trial. So a very different path was followed in Iceland. There's a nice little website link there for the BBC with regard to what happened in Iceland. I'll put that down below somewhere so you can have a look at it. But of course the UK suffered badly, but we here in the North East, we suffered particularly badly because of three reasons. Number one, it's already a relatively poor area, of course, in the UK. We all know that, I'm sure. Its bank was effectively bust, the Northern Rock, now of course owned by Virgin Money, where we have been on a number of occasions to their offices in Gosforth. And then of course, all of a sudden, restrictions became very, very tight on lending, and as a consequence, that made it very difficult for SMEs, small and medium-sized enterprises, to survive. And so a lot of them, as you will know, struggled to acquire liquidity and finance and went under. Now, unfortunately, in the UK economy, some 45,000 businesses are small and medium-sized enterprises. We don't have a lot of big companies, so we really are talking about a very significant chunk of employment here. Anyway, that's it, ladies and gentlemen, on the UK financial crisis, and a brief rundown of where it stemmed from and how it spread from the US to ourselves here in the UK. Bye for now.